Well, with us today is Jim Welsh from Macrotides. Jim, it's good to have you back. I know last month we had you on non-farm payroll, so it seems like our monthly call, if you will, breaking down the payrolls report. So welcome back.
Hey, great to be with you, Blake. And, doing this interview surrounding the employment report, I think is going to continue to be a good idea in coming months because we're going to see, I think, more volatility and a lot more is going to be revealed in terms of the underlying causes of, the numbers coming in weaker than expected. So I think this is a good game plan.
I think it is as well. I've said all of this year that data is going to start to matter, and it's really starting to move the markets. And today we had, the jobs report come in at 559,000 jobs created. The market was expecting 675,000. So it was a little worse than expected. But the reaction we saw was, a drop in the dollar. We saw a drop in yield. Stocks are moving higher. So what is your response to the market's response today?
Well, as I wrote my most recent weekly technical review, and over the last few weeks, my anticipation was and has been that Treasury yields, after peaking on March 30th, we're going to enter a wave 4, which would bring yields down. I thought they would drop about 25 to 30 basis points. We saw a low on May 7th, the last employment report, a tick higher. And I think the pattern is an ABC, so that the door has been open for bond yields to go back down to where they got to on May 7th, which I think was 147 on the 10-year and 216 on the 30-year. But after this pattern completes, I think we're in the second half of this year, we're going to see Treasury yields go up in a wave 5, which means they're going above those March 30 peaks. I think the 10-year will get up at least to about 195, and I think there's the potential it will pop over 2%. If that proves true, it's going to have repercussions in a lot of different markets. So to me, the miss today, Blake, was not unsurprising from a standpoint that the factors that held down last month, kids still being in school, so moms are at home, worried about the virus, and getting paid more, maybe not to work. Those are still at play. They're diminishing as we do more vaccinations and the schools reopen. So, as I noted in the last report, 22 states are going to unwind or suspend the extra payments during the month of June. So when we get the July employment report in the first week of August, we're going to really see just how important those were in terms of diminishing job growth. So I think, the next few months, we're going to see job growth continue to pick up fairly significantly as all these factors kind of go away.
Yeah, so that plays into your idea that maybe yields might drop a little bit, but rally into the year end. As you mentioned, even the last time we spoke last month. And also, as you mentioned, and I'm glad you mentioned it, because in my state, that income from the Fed or, for jobs on a federal level, that's going away at the end of this month. So will it create jobs? And in your take is it will.
Absolutely. No, I mean, there's no question about it. And again, if I'm a person who's worried about getting COVID still, and the government's paying more, they're subsidizing my fear to some extent. So I'm not diminishing that people have legitimate concerns about, hey, I don't want to go out to, into restaurants again and so forth. But again, we don't know how much of a role that's truly playing. Both political parties will either diminish it or I think blow it out of proportion. But the numbers are really going to reveal that over the next 3 months.
That's interesting, Jim. Last time we spoke and last month, when the jobs report came in much lower than expected, this month it's closer to being in line, but still below expectations. You said that it wouldn't sway what the Fed was thinking and what Chairman Powell was going to do in June. And so are your thoughts still the same going into this month? This is a big month for the Fed, for the FOMC, and both for the ECB as well. But how's the Fed going to take the data that came in today?
Well, again, their view and what they want to achieve is to see the labor market more fully recover. So any miss on expected jobs just plays into that narrative. Again, from a sequencing standpoint, the first thing the Fed's going to do is taper their monthly purchases from $120 billion. Rate increases, based on the Fed's projections, they're not penciling a rate increase until 2023. So to me, the way I think things are going to play out, Blake, excuse me, is that the Fed is going to telegraph that they're going to really start talking about tapering when we see the minutes from the June meeting when they're released on July 7th. So that's, to me, it's on the runway. It's just a question of when is it going to take off. The actual event itself may not happen until late this year, early 2022. So what I think is what's going to happen is the inflation is going to prove more intense. Core inflation is going to stay above 3% for the balance of 2021. The Fed's target is 2%. They penciled in 2.4% as being their estimate. So staying above 3%, I think, is going to change the narrative where the markets start to say, hey, the Fed doesn't have it right. Inflation isn't going to be transitory. And the market will start to, as we get deeper into the second half of this year, anticipate that, oh no, the Fed's not going to be able to wait to 2023 to raise rates. They're going to have to move in 2022. And depending on how the numbers play out, instead of one rate hike, the market will start talking about 2 rate hikes. So all that, I think, is going to play into Treasury yields, jumping in the second half of this year. But I also think it's supportive of the dollar.
Okay, so, well, that's interesting because the dollar response today it got beat down a little bit, but we are also range bound in the dollar. It hasn't been moving a whole lot. But do you think the dollar is going to see new lows still? I remember the last time we spoke, you thought the dollar index would actually break down, but only to like 88.50 before bouncing. Are you still in that view?
Yep. Basically, Blake, from the high in January of 2017, I think the dollar is nearing the completion of a big ABC. So my expectation was, at a minimum, we would see the dollar break below the January low of 89.21. The February 2018 low was 88.25. So somewhere between those two numbers, I think the dollar is going to make a low. And I think the narrative changes in the sense that as the markets anticipate the Fed being, forced to be more aggressive, the dollar is going to strengthen on that news. So if I'm right, this big ABC gets completed, it implies a rally back to 100.
Wow.
And maybe 103. Now that's over the next 12 months or so. So it's not going to happen. You have a wave one up, then a pullback. So the range bound that you talk about, I think, is going to continue. So we can rally from, let's say, a little bit below 89 up towards 95-ish, then pull back. But if I'm right, later this year, I think the dollar then will push above 95. And, that has implications for a lot of markets as well. So you've got a lot of forces coming together that I think could influence not only equities, but also obviously the metals.
That's an interesting view, Jim. And I'll tell you, and for everybody listening in, if you really want to get some information or more information about Jim's, the thing he does best is he ties in a macro view with a technical view. So if you want to get more information on Jim and what he does, the link is in the description of this video where you can get to Jim and find out about his newsletter. Jim, I love your views and I love how you put it all together. And I want to thank you for putting it all together for us today on this non-farm payroll day.
Hey, Blake, glad to do it. Appreciate having this kind of conversation with you and being able to, as you say, try to blend the fundamental with the technical, because not too many people do that. But I think it's really key. And it has really been very helpful for me to do a better job of anticipating important market changes, because unless the fundamentals change, the technical stuff is going to only represent, if you will, short-term swings. So yeah, the next few months, 6 months, I think are going to be somewhat historic.
All right. Well, Jim, thanks for being in history with us. And I'm going to see you next month for sure. And hopefully in between then, thanks for being with us today.
Thanks again, Blake.
All right. Have a great day.